lenders requiring you to escrow these rate caps. They're making a difficult situation harder. These really are killing cash flow.
The bank is requiring us to start escrowing money and basically start paying as if it's already expired.
How do you calculate how much? Because cap rates is, you've got to figure out what the limit you're going to buy. How should investors adjust their real estate investment strategies?
Properties are overvalued, and for the next 3, 4, 5 years, values are going to stay flat while inflation kind of catches up and brings values back to that historic trend line. And know that it could be a few years before we see it.
Welcome to Real Estate Syndicator Live. I am your host, Mauricio Rauld. And on this episode, I've got my good buddy, Jay Scott, Bigger Pockets OG, current G of Drunk Real Estate, my co-host over there at the Drunk Real Estate Podcast. And this episode is all about macroeconomics, how economics over the next 6 to 12 months will affect real estate. And as real estate investors, we should all be paying attention, close attention actually, to how the macroeconomic environment is. We talk about, is a recession looming? We talk about some of the biggest risks that real estate investors face over the next 6 to 12 months. We spent a good amount of time actually on rate caps and on insurance, which was a topic that our Real Estate Syndicator Live attendees really wanted to hear about. And we talk about how Jay believes that businesses are going to be the first crack in the upcoming recession. Jay is the co-founder of Bar Down Investments, which is a real estate investment firm specializing in multifamily apartments. Jay is also the author of 5 books on real estate investing, including the bestseller, The Book on Estimating Rehab Costs, which has sold over 500,000 copies in the past 10 years and has helped investors from around the world get their start in real estate. He's also the co-founder of Apartment Addicts, which helps aspiring multifamily investors achieve their investment goals. And yes, you will notice if you're watching this episode on YouTube that I am wearing a winter coat in my office, and that is because the heater did not work and it was cold, and so I was forced to wear my winter jacket this week on Real Estate Syndicator Live. Jay, let's get to it. This is primarily an economics episode and how that ties into real estate, but any questions you guys have, as always, drop them in the chat, please, because I have a bunch of questions, but I get to ask questions all the time, and I want to make sure that we're answering your specific questions. So for those of you who don't know, this is the 4th time Jay's been on, and what we've been doing now is we just bring Jay on every 6 months or so. I think we're a little early today, this one. I think it was 5 months ago, Jay, that you were on next, but I just want to keep bringing Jay on every 6 months to give us kind of an overview, an economic overview of where we are, how that affects real estate. I ask a lot of the same questions because obviously they have different answers, and I want to give Jay props because he has really been nailing these sort of where he sees the next 6 months. This is like the 3rd time we're doing it now, and he's been spot on a lot. So I was going to ask you a bunch of funny questions, but Jay, actually, you know what? Why don't you just start with giving us kind of the overview of where you think we are in the economic landscape, kind of high level. I had a question about recession, all that stuff, but just maybe bring us up to speed over the last 6 months, where you think we are from a macroeconomic standpoint.
So it really depends on who you ask. If you ask the government, everything is going great. And when I say ask the government, I mean, if you look at the data. So there's a lot of data out there that indicates things are actually going pretty well. Inflation is down. It was up again last month a little bit, but it's down close to 3%. Employment, if you look at the headline numbers, looks fantastic. GDP, which is the total output of the economy, is like near 5%, which means we're crushing it. Basically, all the major big economic indicators say things are really good. Now, you go out and you ask people, how are you feeling about this economy? How are you feeling about your personal financial situation? And the answer is a lot different. Consumer sentiment, public sentiment is actually pretty low right now. A lot of people feel like they're getting crushed under the weight of inflation. A lot of people feel like their wages aren't keeping up with their cost of living. Basically, people are unhappy and dissatisfied and frustrated with what's going on. So how do you kind of reconcile these two competing factors? The data looking like everything's good, people saying everything is bad. Well, there's a third leg of that stool, and that's, what is everybody actually doing? And I'm actually a big believer that you can look at the data, you can ask people how they're feeling, but at the end of the day, it's what people are doing that's really going to tell us what's going on. And people are still spending money. People are still acting as if things aren't bad, as if things are pretty good. If you look at Christmas holiday season basically December, Thanksgiving through December of last year, and spending was up about 3% year over year. Now, you could say that inflation was 3%, 4%, 6%, whatever. So maybe spending was a little bit lower than the previous year, but still on order of the same as the year before, when everybody thought things were good, and higher than the year before when everybody was convinced everything was great. So people are spending money. People are racking up credit card debt. That's the interesting thing. Typically, Americans like to rack up credit card debt, but when the economy gets bad, when people are concerned about losing their jobs, they rack up less credit card debt, but not this time. People are racking up credit card debt. So where are things right now? Who knows? The data says they're good. People say they're bad, but people are acting more like the data says than what they're saying in these public surveys and polls.
Yeah, I went through this last time when we spoke 5 months ago, Jay. So I gave sort of the Fed's been obviously raising rates now for since March of last year, almost 2 years now. And so what I ended up doing last time is I went back and looked at all the sort of the indicators of when they started raising rates. So this is when rates were basically at 0 or a quarter of a point. And like the S&P started at 4,300. It was at 4,300. And when we spoke last time, it was at 4,500. So it had gone up a little bit, but basically flat. And then today it's at 4850, right? So it's gone up a good 10% since we started hiking rates, right? From 0 now all the way to 5.25. Unemployment rate has inched in slightly. It was at 3.5 when we started. Now it's at 3.7. So not terrible. Certainly not something to be correct. GDP's gone up. It was at 25 trillion. Then last time we met, it was about almost 27. And now it's at almost 30 trillion. So that's up about 10% over the last couple of years since the Fed's hiking up. And the fun part for us, I guess, is real estate prices, at least in the single family world anyway, they continue to go up, even though the Feds, that's one of the targeted things they're trying to do. They're trying to slow down the cost of inflation on the housing side. So it really does beg the question. And I asked you this last time, has the Fed pulled off this soft landing? Have they now orchestrated this thing? Because they're talking about cutting now, or they're talking about maybe not raising anymore. Have they been, I mean, should we be busting out the champagne?
Well, let's define soft landing. So
Yeah.
if soft landing means the Fed has avoided a recession, I don't think we can celebrate just yet. But if we refer to a soft landing as the Fed basically pulling off this kind of miraculous accomplishment of not crashing the economy by raising interest rates 5 points over 18 months, which is a huge rate. I mean, we went from basically 0% to 5.25% federal funds rate in 18 months. I think if you would have asked anybody, if like 3 years ago, if they did that, what would happen? And the answer is like, we would crash the economy. Things would slow down because things became so expensive to buy. The reason why raising interest rates helps inflation is that people start to do two things. One, they start to save more money because you can now get like 5% in a money market or a CD. So you got to start saving your money because you're getting good interest. And two, it becomes really expensive to buy stuff. Mortgages go up, loan costs go up, interest rates go up on everything, your credit card rates go up. And so people stop buying. And so between the more saving and less buying, raising interest rates slows things down. So raising 5.5 points, 5.25 points should have led in based on all historic instances of us doing similar things to a big slowdown in the economy and maybe even a crash. And that didn't happen. So even if we do see a recession, and I think we will see a recession on the horizon, assuming it's not a big one, I think we can safely say that the Fed has pulled something off that's pretty akin to a soft landing.
And do you think do you think the real estate world, because I do feel like, especially in like the commercial world, like that market has struggled, right? It's hard to argue that the higher interest rates haven't caused some issues in the commercial world, even in our in multifamily, which is your asset class. It's undeniable that the interest rate hikes and the speed at which interest rates went up had a major effect on cap rates and the ability of folks to be able to refinance and get out of that. So how do we reconcile what's going on the commercial world, maybe in multifamily, and the rest of the economy? Why is it different there and not different in the real economy?
So one thing I want to point out with multifamily, and I don't do other commercial asset classes, but I suspect it may be similar in other classes as well. And AJ on the podcast has talked about this in self-storage. It's pretty similar there as well. We haven't seen this kind of linear uh, degradation in prices and values over the last 18 months in multifamily. What we saw was in March of 2022, when the Fed started hiking interest rates, basically there was a crash. We saw values drop 25, 30% over 2 or 3 months. And since then, since let's say July, August of 2022, values really haven't gone down or up. Things have kind of plateaued. So we did see a big drop in the first couple months, but then after that, I mean, things have been pretty flat for the last 18 months or so. So yeah, there was an impact from interest rates starting to go up, but the last 4.5 points in interest rate hikes haven't affected the multifamily world any more than the first half or 3/4 point hikes. So yeah, long story short, I think multifamily is pretty reflective of everything else. It may have been that there was more of a bubble in multifamily. Cap rates were super low. I mean, just to an unsustainable point a couple years ago. So it's possible that what we saw was just kind of a quick deflation of that bubble. And now, just like the rest of the economy, things are pretty stable.
And I will add that, this is obviously anecdotal evidence. It's not like statistics or anything, but I mean, we obviously represent a lot of multifamily, and I can see that there are some issues underlying, right? There are still a lot of people whose their loan terms, those bridge loan terms are coming up, they're expiring. They're not going to be able to refinance. Their values have dropped 20%, even though they've dropped, those dropped back in March. So there is some rumblings going on there, which I think are going to spill over to 2024. But and I wonder then, the question I guess for you, Jay, is, how much stock do we put on this argument that there's always a lag, right? There's a lag from the time the Fed and interest rates start going up to the time you actually feel it in the economy, and that's one of the reasons why, like in multifamily, you don't refinance your loan every month, right? So if interest rates suddenly spike, it doesn't affect you for another 18 or 24, maybe even 3 years down the line when it's time for you to refinance, right? And if you're in the single family space and you have a 30-year mortgage, it doesn't even affect you at all in terms of, being able to continue making the payment. What are your thoughts on the lag effect of what the Fed's doing? And have we seen everything already been kind of baked into the economy, or is this something that's still going to continue over the next 6 to 12 months?
Yeah, and anybody that's again listened to the Drunk Real Estate Show knows that Mauricio and I have talked and even debated on this topic over the last few months. But I do think that a lot of that lag has now been baked in. I mean, again, it's been almost 2 years since we started hiking interest rates. We're at 21, 22 months. So we're pretty close to that 2 years. Typically lags are 6 months, 9 months, maybe 12 months. Though there are things, like you said, mortgages, like and resetting of short-term floating rate debt, which isn't common in the residential space. It's more common in the commercial space. Yeah, those things are going to take longer to work its way through the system. But I think a lot of those interest rate hikes have already worked their way through. I think there is still some lag. I mean, we were raising rates through, what was it, November, December. So it's very possible, I guess it was November, so it's very possible that we still have another 6 months or 9 months of those rate hikes working their way through the system. But here's the thing. The Fed has now indicated, if you listen to the Fed back in December at their last meeting, they indicated that they're pretty willing to start dropping interest rates if they see any negative effects to those hikes that we've seen over the last 2 years. And that was kind of I think that's part of what's spurring the market right now. We've seen the stock market take off over the last month. We've seen crypto go up over the last month. We've seen treasury yields drop over the last month. And I think a lot of that was the Fed coming out and basically saying, yeah, if we need to lower rates in 2024, even early in 2024, we're happy to do that. For the last 2 years, they've basically been saying rates longer for higher, or rates higher for longer, excuse me. Sending this message that we're not going to lower rates unless we absolutely have to. Now they're sending the message that we're happy to lower rates. So I think even if we start to see some issues in the economy, the Fed's going to reverse course quickly, and there's enough pent up demand that I think even if we see a recession, it's going to be a small one.
Yeah, by the way, drop your comments, questions in the comments. There's a lot of activity in the comments. They're all statements, Jay. They're coming back and giving us their thoughts, which I love. So keep coming out. Vessi was talking about how people are racking up credit cards, which you talked about earlier. Their saving rates is an all-time low.
Yep.
Jared says consumer spending is crazy. Like where are people getting money? Like where are people getting the money to go buy all that? Christmas shopping was crazy. It was like, people thought it was going to slow down. People seem to not be affected and they keep spending money from somewhere. Yet all the data we look at is your credit cards are going up, saving rates are going down. Is that it? Is everybody just spending money on their credit cards?
Well, I like to think of like the economy from a socioeconomic standpoint as kind of being three-tiered. Number one, there's kind of the stuff we need to buy every single day. We need to be able to buy gas. We need to be able to buy food and clothing, all the stuff we need to live on, the commodities. Second tier is kind of the hard assets, real estate, stock market, treasury bills, treasury bonds, those sorts of things. And then you get up into the luxury items. People buying yachts or airplanes or Rolexes or things like that. And if you kind of look at where spending has gone over the last 6-12 months, what we've seen is there's been a slowdown in some of that commodity stuff. So Target and Walmart have indicated that people are spending less and they're being a little bit more frugal. Commodities prices in general are dropping, which indicates that demand is reduced at least somewhat. So at the very low end, maybe we are seeing some slowdown in spending. Then at the high end, I shared with Mauricio yesterday an article that whiskey like collector whiskey and trading cards and Rolex watches or high-end watches, prices of those things have dropped off a cliff over the last 6 to 12 months. So people aren't buying these luxury goods nearly as much. But the piece in the middle, those hard assets, that seems to be where people are spending and putting a lot of money. People are spending a lot of money on vacations, and people are putting a lot of money into the stock market and things like that. Who are those people? Those are the top 10 to 20% of the wealthiest Americans. They may not be the top 1%, those buying the yachts and the Rolexes. They're not the bottom 80%, the people that are spending all of their money on clothes and food. They're the people that make a decent living, that probably made a lot of money during COVID, probably got a lot of money in savings or started with a lot of money in savings, and they're spending it. And so in my opinion, what we're seeing with all the spending is we're seeing kind of these top, let's call it 10, 20% of Americans, basically going through the end of their savings, and going through their credit. And so I expect that that's going to have to stop at some point. And again, I think the lower 80% are already slowing down. If you look at some of the statements by some of these consumer retailers, and so how long is it going to last? I don't know. How much more money do people have? I don't know. I was saying this to Mauricio on the show last week, that for the first time in a long time, and I don't say this, I don't say this to sound like I'm out of touch or I'm bragging or whatever, but I've been very fortunate that for the last 20 years or so, I've been able to go out to eat or go to the grocery store and buy food or buy meals and not really have to look at the menu or the prices, because it's just one of those things I could afford it. Well, I'm starting to recognize how expensive restaurants are getting and how expensive food is getting. And just the fact that I'm noticing it is saying that this is a big difference than what we've seen over the past several years or maybe even several decades. And I'm changing my spending patterns, even though I can afford it. And that tells me that there are probably a lot of people out there that are going to be changing their spending patterns pretty soon as well.
Yeah, and for those of you who don't know, Jay is also an investor in horses, horse racing. Where does that fit in the category of? Is it a luxury item? Is it a middle tier? Where does horse buying? How are the horse prices going these days?
So horse prices are staying pretty steady, and it's because a lot of people justify it as an investment, even though anybody out there that's thinking it's a cool investment, it really is not. I love animals. I love horses. I like to be able to visit my horses, and we've been fortunate that we haven't lost money on our racehorses, but we're not making a lot of money either.
You still owe me a trip to Kentucky Derby. So
absolutely.
Jeff asked, what are your thoughts on the corporate greed, and that, they're claiming record profits on the one hand as they hold the line on their prices, even though their costs have gone down? Any thoughts on that?
Yeah. So I haven't looked at the raw data myself, but there have been a number of articles that have come out over the last couple of months. In fact, I think I read one just the other day from some senior economist at some place that I thought that's respectable. I don't remember exactly who it was or where it was, but basically looked at the data and was estimating that about half of the price increases that we saw since COVID were actually corporate profit taking. And so I don't know exactly how you quantify that data. I mean, you can look at the cost of goods and the cost of labor, and you can kind of guess at margins and stuff. But there are a lot of private companies where you don't really see into all their financial data. So there's probably some guessing going on, but there's no argument that a good bit of the price increases that we've seen over the last couple of years has been corporate profit taking. And all the public companies, I mean, if you look at their data, you can see that their revenue and their margins have increased extremely a whole lot over the last couple of years.
Yeah. Well, let's tie this back to real estate because I want to give you props again because even though, on the show on Drunk Real Estate, he and I always butt heads. A lot of it is I just try and take the opposite argument. Jay knows way more about this than I do. But the last couple of times we've asked you about the biggest risks that you see in real estate, in the next 6 to 12 months, and you've been nailing it every time. And I'm wondering whether your answers this time are going to be different. But the last time, when I asked you what the biggest risks are, you saw interest rate risk. Because obviously interest rates were going up. And by the way, the first time you said that, we thought interest rates were going to go up, but we didn't think it was going to go all the way up. And you continue to hit that. You said rate caps was another one. So let's just revisit some of these. Like, well, let me ask you this. Do you think interest rates are still a risk at this point to real estate investors? Or is that pretty much behind us now? And we can look to either stabilized or lower interest rates.
So what we've seen in the multifamily space is a lot of banks seem now willing to work out with distressed investors, distressed owners. I think part of that was they remember 2008, and anybody on this call that remembers 2008 kind of remembers that banks got crushed. And a big reason they got crushed was they were taking back all this real estate and then selling it at pennies on the dollar at auctions and REO sales. And I think in retrospect, if those banks could have a do-over, and maybe this is their do-over, they wouldn't have foreclosed on all those properties. They would have tried to push out some of those foreclosures in hopes that the economy improved, which it did, and those owners could start making payments again. But they didn't do that. I think they're starting to do that now. They recognize they don't want to take back all these assets and have to sell them for pennies on the dollar. They'd rather work out with these owners, hope that the economy improves over the next year or two, and then they can resume payments and catch up their lost payments on the back end, and everything will be good. Everybody will be happy. And so banks are a lot more willing to do workouts now than they were at any point in the past that I remember. And the Fed has stepped in and basically encouraged banks to do this. Some federal regulators have stepped in and said, hey, if you work out with these owners, I know it's going to impact some of your financial statements. It's going to make some of your books look a little bit worse than they would, but we'll ignore that when we do our quarterly audits on you, or however often they do the audits. When we do our audits, we'll kind of ignore this risk you have on your books by working things out with owners because we think it's the right thing to do. So when the government's encouraging banks to do it, banks are going to be more serious about it. So I think we are going to see foreclosures. We're going to see some owners that got in way over their heads, and even a workout with the bank isn't going to help things. But I think a lot of these owners who are distressed right now are going to figure out a way to come to a deal with the banks and push off all this distress for a year or two in hopes that interest rates start to come down and everything gets back on track.
Yeah, before we move on to the next one, actually, I interviewed, Ferris Musso from Disrupt Equity. It's a YouTube video, actually. So if you guys, a little plug there, if you want to go check that out on the YouTube. And he had just met with some of the lenders. That is exactly what he said. The lenders are willing to work. Obviously, it's got to be a savable deal. But if you're just having some issues, it's a good asset, and it's an interest rate thing. They are willing to negotiate with you. They may not cut the loan amount, but they'll work with you. Maybe the arrears can be tacked onto the back, and they'll pull other levers. So if you're interested in that, I'd highly recommend you checking out that interview I did probably a couple months ago with Ferris. What about rate caps? Is that still an issue for you guys? I know at some point, the first time you and I met about a year ago now, rate caps were like off the charts. They were ridiculous. I know they calmed down a little bit. Where are we today in that world? Are they still sort of unreasonably high? Is it prohibitively high, or has that settled down a little bit?
Yeah. So for those who aren't familiar, rate caps are basically these insurance policies that lenders make their borrowers get when the borrowers take out this floating rate debt. When we have these adjustable rate mortgages, the lenders say, hey, you need to take out this insurance policy so that if the interest rate goes too high, there's an insurance company that's covering the difference, not you, because we know your property can't support interest rates that are too high. And so these insurance policies typically last 1 or 2 or 3 years. And when they expire, if you still have the loan, you need to get a new insurance policy. And because rates have been going up so quickly, these insurance policy costs have been going through the roof. And so to put some real numbers there, we bought one of these insurance policies in 2020 for one of our properties. We were paying $20,000 per year for the insurance policy. And then we had to renew that insurance policy about 3 months ago, and we paid $480,000
Wow.
for a year. So
Wow.
20,000 to 480,000. And there are some other operators out there that are seeing that their policies go up even more than that. Is it still a concern? Yeah. Those policy prices are driven by two things: interest rates and volatility. There's less volatility in the market now than there was. People don't think rates are going to keep going up, but rates are still pretty high, and insurance companies are still pretty conservative. So those rate cap insurance prices are still actually pretty high. I'm on a deal right now. I'm an LP. I'm a passive investor with an operator right now who sent an update last month that said that he has this year deals coming due that he has to buy new rate caps on, and the rate cap prices are $18 million higher than when he originally purchased them on these deals 2 and 3 years ago. And this is a $100 or $200 million portfolio, so it's a big portfolio, but still $18 million is kind of this unexpected cost per year. So yeah, the operators are still getting in trouble with rate caps, and it's still a risk to the market. And in my opinion, it's probably the biggest risk in the market right now, though I don't think it's nearly as big a risk as it was 6 months ago when we talked.
Josh was asking, without a rate cap, is there a limit to how high the rate could go? What's the cost and risk analysis there? Is it just, always get insurance, or how do you calculate? Actually, let me follow up on that, because the same question, but how do you calculate how much? Because cap rates is, you've got to figure out what the limit you're going to buy and how long. But why don't you explain a little bit about the limits, and what do you recommend in terms of what type of rate cap you would typically look at?
Yeah. So first of all, you don't really have a choice. Banks they're not smart, but they're not really dumb. If you get a floating rate loan, banks will almost always, not always, and we've actually seen a couple lenders. Arbor is a name you
Oh,
may
you're
have
naming
heard.
names. Ooh, you're naming
Yeah.
names.
Arbor's a lender that's had to take back a couple properties because they didn't require their owners to get rate caps, these insurance policies, and how high can rates go? They can keep going up. I mean, it's basically it's pegged to either like the 7-year treasury, or it's pegged to some other floating rate that the government maintains. And as long as those rates go up, then the interest rate on the loan goes up, and there's no upper limit. So, but banks will typically require this, almost always require this. So you don't really have a choice. What you do have a choice in is, do you buy a 1-year insurance policy, a 2-year, a 3-year, and do you buy a policy that protects you in case rates go more than 1% higher, or more than 2% higher, or more than 3% higher? There's a lot of intricate math that goes into making those decisions. But what we found is that those policies are pretty efficient, meaning if you do a 2-point policy, meaning you expect, or you want the policy to protect you in case of a 2-point rate increase, the cost of that policy is going to be pretty much around whatever you would end up paying in additional interest if rates went up 2%. So if rates go up 2%, you break even. If they go up less than 2%, you've spent too much money. If they go up more than 2%, you make money. And then from there, it's really, you just need to make your best guess at where rates going to go and in how long, or you decide how conservative or aggressive you want to be, and how much cash you have sitting around that you can use to pay for these policies, and you make the decision from there. So it's difficult to make that decision unless you're really good at guessing where the market's going, and few of us are.
Yeah, and by the way, guys, keep asking your questions. I'm making my way through them. But on the rate cap, I actually had, as a reminder, obviously rate caps only have to do with when you get a variable loan. Some people are just saying, "Hey,
Correct.
it's too scary. I'm just going to start doing the regular loans like that." Oh, my question was going to be, I presume we're talking about still having a high rate cap, meaning a high insurance premium. Those are for the existing loans, right? Because if I'm going to go buy a brand new property, not brand new, but if I buy a property today and I'm already paying, seven, I don't even know what the interest rates are on a commercial loan, but let's just say I'm paying 7 or 8% right now, and that's
Yep.
what I'm buying. The insurance is going to cover me for the risk of insurance going up even further, right? Because I'm going to have right. So I presume it's because we're talking about existing loans where I bought the property at a 4%, right? A 4% interest rate. I bought a cap so it would go higher than 6. Now interest rates are, what are they now, Jay? Ballparks? What are we at? 7-ish?
No, so you're saying
6.5?
6.5
Okay.
for fixed rate. Yeah,
Yeah.
7.5 for floating rate.
But I'm still, if I didn't have the rate cap, my 4% has gone away. And so I guess it's for the new deals that the interest rate, the thing is not an issue. It's for the existing one when you're trying to renegotiate the rate cap. That's why it's still high, because you still had pro forma at a pretty low interest rate when you got in 2-3 years ago.
Exactly.
Yeah.
Exactly. So yeah, this is a lot less of a risk for new deals than it is for deals that were originated between 2020 and 2022.
Paul had a great question because it was on my list, so I'll ask it. We talked about banks a little bit last time. It's almost a year ago now that we had the little mini banking crisis that conveniently got papered over by some Fed lending facility. Where do you think the banks are today? We've talked about them holding a lot of, especially the regional ones, commercial paper on their books that that aren't doing so well. Is that a concern to you at all? Is the health of the banking system something that you are looking at in terms of trying to figure out where we're going in the next 6 to 12 months?
No, only because the government has been pretty clear about the fact that if banks get in trouble these days, they're going to get bailed out. Even the smaller banks, even the regional banks. Back in 2008, obviously, we saw bailouts of some of the largest banks. We didn't see nearly as much bailout of the smaller banks. This time around, it's looking like the Fed's willing to bail out everybody. Silicon Valley Bank last March or February, whenever it was, they were at risk of failure, and the bank set up this pot of money and this program called the Bank Term Funding Program, where they basically told banks, hey, if you need money because you bought treasury bonds at the wrong time and you're losing money and you don't have enough liquidity, come to us and we'll essentially give you a loan at a really low interest rate to bail you out. And a lot of banks have taken advantage of that. And while the government's talking about ending that program this March, I suspect that they'll either continue it, or if something happens, they'll put something new in place. So I'm not really concerned about a banking crisis. I'm not concerned about any of us on this call losing any money, regardless of if we keep over the FDIC limit in our banks. Are there some banks that may have some issues and may end up having to sell or get bought out or get taken into receivership by the state or the federal government and sold off? Yeah, there are some banks out there that have high exposure to commercial real estate. And while in and of itself, that's not necessarily bad, if they have a high exposure to office in some areas, that can be bad. If they have high exposure to some other asset class that we haven't seen fail yet, but could in the future, certainly that's a risk. Anytime you're over leveraged in one asset class, you're at risk. But I don't know, a lot of people out there talking about bank failures as being a big risk right now. I've been saying since last February, when the whole SVB thing happened, that I see very, very little risk.
And you've been right so far, my friend, even though we've argued that point a little bit on the show. But let's go back. Look, it's not a fascinating topic, but everyone's really interested in the insurance and the rate caps. Jay, Kara's asking if you're going variable, are you underwriting now your rates going up in the next few years, and if so, how high? I've heard calculate as high as 3% higher. What are you guys doing?
So right now, we are not really thinking about variable rate debt or short-term floating rate debt just because our investors don't want us to. I'm fairly comfortable. I'd be fairly comfortable getting a floating rate loan right now, maybe getting a cap at 2 or 3%, excuse me. So basically paying less money to have more of a gap between when I have to, how long I have to keep paying versus the insurance company taking over. Because I don't think we're going to see rates go up very much. Now, keep in mind, it could be 3 or 6, and we'll probably talk about this, or 12 months before we see any rate cuts. So I don't necessarily think rates are going to go down over the next few months. They could stay the same. They could go up a little bit. They could go down a little bit. I don't think we're going to see a big movement in rates over the next 3 to 6 to 12 months. So I'd be comfortable getting a floating rate loan right now, but a lot of investors don't want to invest in deals where that's the case. So we're doing our best to kind of avoid that situation for anything we're buying.
Are your investors still, I mean, it sounds like they are pretty sensitive and really getting more focused on return of principal more than the return they're getting?
Certainly they are. They're starting to realize that this thing that was an easy way to make money for 10 years and basically you don't really do your due diligence. You just throw a bunch of money in, you get your 16, 18, 25% returns and everybody's happy, was not necessarily as safe as what they thought it was. So yeah, a lot of people are now more concerned about protecting their principal. But in my experience, the people that are the most concerned about protecting their principal are the ones that already have money in deals. Moving forward, people still seem to be pretty risk tolerant, assuming that they don't see any big red flags. And so we could talk all day about floating rate loans versus fixed rate loans. I could tell you why I think floating rate loans aren't very risky right now compared to a few years ago. But everybody's reading headlines about how all these deals that have floating rate loans are getting in trouble, even though, just like you talked about, Mauricio, it's the ones that got those loans 3 years ago that are in trouble. But people don't think about that nuance. They read a headline that floating rate loans are getting people in trouble, so they don't want floating rate loans right now.
Yeah, that's something you brought up. I remember we were at a retreat a couple of years ago here in Laguna Beach, actually, and you guys brought this up, which is like you poll your investors quite frequently to figure out what exactly they need or want or what they're looking for, which I think is super smart. I presume this is one of the questions you're asking them.
Absolutely. And so for anybody out there that has investors, make sure you're asking your investors like what they're looking for, what level of returns they're looking for, what areas they want to be investing in, what types of deals they want to be investing in. Because it's a lot easier to find a deal that your investors want than to find investors when you have some random deal.
Yep. Let's continue because Vessi had a question on insurance as well. Any thoughts on how to manage insurance and reinsurance risk, especially for markets like Florida? And I know you and I have talked about the market of Florida, and that's where you live, by the way. Yeah, so that's where Jay lives. This has personally caused me to put Florida on pause for both GP and LP opportunities I consider. How do you manage the risk in places like Florida?
Yeah, so I partnered with my partner, Ashley Wilson, back in 2018, 2019. And I remember when we first started partnering, we were talking about markets we wanted to be in. And I had just moved to Florida. And I said to her back then, we're not investing in Florida. And this was before we started seeing insurance problems in Florida. But it was just, it's a catastrophic risk. And this is the way I think about insurance and other risks is there's two types of risk. There's that risk that you can manage and you can pay for, things that will cost you money. And then there's the catastrophic risk, the things that will cost you a deal, things that will cost you your livelihood. And I'm less concerned about investing in a deal where, and don't get me wrong, I don't like to be in these deals, but I'm less concerned about investing in a deal where insurance goes from $1,000 a unit to $2,000 a unit per year than I am in a deal where insurance goes from $1,000 a unit to that property is now uninsurable because it got hit by 3 hurricanes. Because once something's uninsurable, its value is essentially zero. And so for me, that's the risk that I want to control or that's the risk that I want to mitigate against. And Florida to me has always seemed like one of those places. And yes, I live here and I live on the coast and I own some single family rentals here. But it's a risk that I'm not willing to take with investors. And so we invest in Houston. I don't see that catastrophic risk in Houston, but certainly we're seeing insurance rates go through the roof in Houston. And it's making us think about whether we should be pulling out of that market, selling off the stuff that we have and moving into other markets. And we are seriously considered doing it. So what I would tell anybody is think about what the biggest risks are and think about how you'll mitigate them. And then also think about, are there any catastrophic risks? And if the answer to that question is yes, run.
I love all these questions on insurance. It's not the sexiest thing, right, Caps, but it's obviously such an important topic for syndicators to really get their minds around. Kevin was asking,
and it's the hardest question. These are the hardest questions for me to answer, because insurance companies hire really, really smart people, actuaries who they don't go by the stuff I'm saying. They don't go by like just talking about this and common sense. I mean, they have reams and reams of data and historic data and statistics and everything to kind of make their decisions for them mathematically. We don't have that.
You know, Kevin, this is a great question from Kevin, because we've also discussed this, and I know our your partner Kevin. I'm sorry, Kyle. Kevin. Lenders requiring you to escrow these rate caps, future rate caps. These really are killing cash flow, right? I mean, this is one of some frustrations a lot of syndicators make, that they're making a difficult situation harder by requiring you some potential future event that we're not quite sure is going to happen. We want you to take that money, almost like additional insurance proceeds, stick them in an escrow account. Can you talk a little bit about that and how that's affecting cash flow, or how people should think through that?
Yeah, and I'm trying not to bore people, but you keep asking me these questions, so I'm
They
happy
want to
to
know.
answer.
Hey, this is what I love about this show is we get to ask the syndicators question, not mine or yours.
Yeah. So just to give an example of what that means is, I mentioned that we had to buy a new rate cap, a new insurance policy back in September of 2023, because the one we bought in September of 2020 for 3 years was expiring. So 3 months ago, 4 months ago in September, we had to write a check for $480,000 for this new rate cap. But the bank wasn't happy with us just trusting that we would have $480,000 sitting around to buy this new rate cap. So a year before the rate cap expired, so September of 2022, the bank said, okay, we're a year away from this rate cap expiring. We're going to make you start escrowing for the new one, the one you have to buy 12 months from now. And we're going to take today's price for that rate cap, and we're going to divide it by 12. And that's how much money you have to put in escrow every month. And so a year before, I think we were like $630,000, the cost of that rate cap. And so 630 divided by 12, which is what, 50,000 something dollars per month. We had to start putting in escrow $50,000 per month, even though we were a year away from having to buy that rate cap. And even though a year later, that rate cap could have been down to $30,000 again, nobody knew. But the bank didn't want to take that chance. So a year before that rate cap expired, we had to start escrowing money. And so, yeah, this has been a big hit on cash flow for a lot of deals, that even if a deal has a rate cap that's not expiring for another 6 months, 12 months, the bank is requiring us to start escrowing money and basically start paying as if it's already expired. And so this isn't just a risk. If you're in the middle of a deal, or if you're invested in a deal and you're told the rate cap is expiring in July of 2024, this has been a problem now since July of 2023, because that operators had to start escrowing for that rate cap a year in advance. And so we're seeing a lot of properties that are getting into trouble a year before they otherwise would be getting in trouble, especially if you think rate caps are going down, because we've now peaked on interest rates, but banks don't care. They're still assuming that you're going to have to pay that big bill a year before. And so they start escrowing.
Like insult over injury. I know we've got a few more minutes here, Jay, before I let you go, but you talked a lot about last time and during our podcast a lot, that your belief, going back to the economy now, is that businesses are going to really be the first people to crack, not people, but first place you're going to see cracks in the economy. If we're going to see a recession, or when we see a recession, the first place you're going to see is businesses. Can you discuss why you think that, and is that something you still continue to believe today?
Yeah. So a lot of businesses, whether we're talking about the Walmarts of the world and the Targets of the world, or whether you're talking about these small tech startups that get capital from banks and venture capitalists and everything in between, they rely on debt. These businesses are sustaining themselves by borrowing money, and typically they're borrowing money short term. So they're either borrowing from a bank for 3 or 4 or 5 years, or they're issuing bonds, which bonds are just debt. for 2 or 3 or 4 years, or they're raising venture capital from investors, and that typically is 2 years worth of money. But a lot of it is short-term debt or short-term investment that eventually is going to need to either be refinanced or they're going to have to get new debt. And businesses for a long time got accustomed to being able to get this debt at certain rates, 3%, 4%, 5%, because interest rates were low. Suddenly, interest rates are now through the roof comparatively. I mean, not compared to the 70s and the 80s, but compared to the last 15 years, interest rates are through the roof. And all these businesses are coming up on that 2 or 3 or 4 or 5 year mark where they have to refinance or get new debt. And now suddenly debt's costing them a whole lot more money. And so a company like Walmart, for example, they raise money through issuing bonds. And they were able to issue bonds that investors were willing to buy at 3 or 4% a couple of years ago. Now investors are looking for 5 or 6%. That 1 or 2% on the billions of dollars that they're raising is a whole lot of interest that Walmart needs to pay. And that's going to cut into their bottom line. And they're not going to go under because of it, but they're probably going to pass that on in terms of higher prices. Now you look at some smaller companies, you look at the tech startups. These tech startups raise money from venture capital firms. They generally raise enough money to get them 2 years worth of what we call runway, 2 years worth of capital to run their business. And then 2 years later, they have to raise more money. Well, venture capital has stopped investing money because investors are worried right now. And so a lot of these businesses that had 2 years worth of capital are now coming up on that 2 years since interest rates have gone up and venture capital has slowed down. And suddenly they're getting ready to run out of money and they can't raise more money. And so everything from small businesses that are running out of money that aren't going to get capitalized to big businesses that will be fine, but they're going to pass on increased prices because the borrowing costs have gone up. That's all going to impact the economy. We're going to have people losing jobs. A lot of these tech companies, I mean, you're probably reading about all these tech companies laying people off. Big tech companies happens all the time. We're reading about it more now, but that happens all the time. But you're not reading about these small tech companies, these 50, 100, 200 person companies that are now laying off 10, 20, 30% of their staff because they're running out of money. They need to be able to save up for as long as they can because they don't know when they're going to be able to borrow or get venture capital again. And so 10, 20, 30%, we're talking about 1 million employees in these small companies right now, or 5 million employees, excuse me. It's a 500,000 companies, average of about 5 million employees. 20% of them get laid off. That's 1 million people getting laid off. So I personally think that the increase in interest rates, increase in borrowing costs are going to cause a lot of layoffs, going to cause a lot of small businesses to go bankrupt, which is obviously going to cause more layoffs, and is going to cause a lot of big businesses to have to raise prices to cover the spread on the cost of their debt. And so that to me is the biggest risk to the economy right now. And it's going to remain a risk until interest rates start to come down.
Yeah, I would agree 100%. I mean, I remember Elon Musk, when Tesla, they were borrowing money at like 2%. There was, and Apple, the same thing. They're borrowing all this money at like literally 2%. And obviously today, you're competing with risk-free interest rate of like 5%. You can get something like that in a money market fund. But and then we talked about the zombie companies like in the S&P 500. Like I think the stat I saw was like 2/3 of them were relying on debt to even stay afloat. So to your point, once the debt becomes due and they're going to refinance, they're going to have to either lay people off or they're going to go out of business. It's almost like the multifamily space, but
I was just about to say that.
Microsoft, yeah.
Yeah, I mean, in multifamily, a lot of times or in commercial real estate, we get these short-term loans. Businesses only get these short-term loans. I mean, the longest loan you're going to get into business is 5 or 7 years, and most of them are 2, 3, or 4 years. So yeah, it's. I think it's literally the biggest risk to the economy right now.
Sounds good. Well, one last question, I'll let you go. Given everything you've talked about today, how should investors adjust their real estate investment strategy? Just talk about investors in general. Maybe talk about syndicators and specifically, but how are you adjusting and how should you think investors should be adjusting their strategies given where we are?
Well, let's break that into single family versus commercial. In the commercial world, we've seen values drop a considerable amount in a number of asset classes. I'm going to talk about multifamily just because it's what I know. But in the multifamily space, we've seen values drop 25, 30% across the board over the last 2 years. And I know that scares a lot of people, but you have to ask yourself, Like, are you more scared now that values are 30% less than they were, or more scared when values were 30% higher? You didn't know to be scared when values were 30% higher. But unless you think real estate's going away, unless you think that real estate's going to collapse long term, now's a better buying opportunity than it was 2 years ago when prices were 30% higher. Do I think we're necessarily at the bottom? Not necessarily. I think we could go down a little bit further. Things could be rough for the next couple of years, but if you're buying right, if you're getting the right type of debt in place, if your time horizon on that debt and your operations is far enough out, 5, 10 years, I don't see a lot of risk. And so we're pretty bullish about buying this year, because again, we're conservative on our debt, we're conservative on our timeframes, and I'd rather be buying now 30% less than what we would have been buying 2 years ago. And everybody was buying 2 years ago. So if everybody was excited to buy when prices were 30% higher, I don't know why they're not excited to buy now. In the single family residential space, things are a little bit different. I think we're probably still at a peak. I don't think we're going to have a major correction. I suspect that properties are overvalued, and for the next 3, 4, 5 years, values are going to stay flat while inflation kind of catches up and brings values back to that historic trend line. So I don't think it's a bad time to be buying single family if you think that you can get the numbers to work. If you can float a deal for a couple years, it's likely that interest rates are going to come down. You can refinance. I'm not telling people buy now, just planning to refinance. Only buy now if the deal makes sense now. But if you can get a deal to make sense now and interest rates come down in a couple years, well, a single becomes a double becomes a triple might become a home run deal. So yeah, be conservative on your single family. And know that it could be a few years before we see a pop in prices. And there could be some downside there as well. But again, I don't, just like with the recession risk, even though I think it might be coming, I don't think it's going to be a bad one.
I'm putting your, I know investwithjay.com is one of the places people can find you to invest, but where should somebody, I know you've got an amazing newsletter. I know you talk about a lot of the economic stuff, I think either weekly or bi-weekly. Where's the best place people can find you, and where can they get on that economic update you do all the time?
Go to jscott.com, and that will link you out to everywhere. Definitely sign up for the newsletter. I send out a newsletter. I try and do it every week. It ends up being pretty much every other week, but typically we'll talk a lot about the economy and other stuff that other people don't typically talk about.
And where should people go follow you? What's your preferred social realm?
J Scott Investor on Facebook, Instagram, and LinkedIn.
Sweet. And then obviously don't forget to see him on Drunk Real Estate YouTube. Give us a subscribe. Otherwise, it'd be great to follow. Thanks so much, everyone, for the questions. Any parting thoughts, Jay?
No, but I am going to put Drunk Real Estate Show.com.
I didn't even know we had a URL. There you go.
We do.
Yeah, I appreciate it, Kara. Yeah, we have a lot of fun with that. It was a lot of fun to start it. I mean, it's getting some traction. So anyway, my friend, I know you're busy these days. Almost an hour with us. Really, really appreciate you, buddy. I'll see you tomorrow night with a couple drinks. What are we doing tomorrow? Are we doing some red wine, or are we doing? Are you fasting again?
I am fasting right now, but I will be drinking wine tomorrow night.
Awesome, man. Looking forward to that. Thanks again, and everyone, if you have a virtual applause for our good friend Jay, and we look forward to seeing you back and having you back in about 6 months, and see. By then, I'm sure the recession will be here. So it'll be fun times to talk about that. All right, buddy. Thanks again, man. If you'd like to join us live on these episodes and have a chance to get your specific question answered, you can simply go to realestatesyndicatorlive.com and register to be live on the show. Hope to see you then.